But like, here's one thing I will tell you. If I didn't have a mic in front of my face or a camera in front of my face every day of the week, I'd be trading a bunch of these things, okay? That's how I was trained. That's how Guy was trained in the commodity market. And you know what I mean? Like, momentum's momentum. And it's a great opportunity to make money, especially in a bubble. And that term bubble doesn't have to be a negative thing. But as a pundit, I can assure you, I'm just not going to be on the sides of bubbles because I've seen what happens when they burst. Largely for the people who get sucked in and they don't know how to get out, right? They don't know how to take a profit, and they certainly don't know how to take a first loss, okay? We're not going to fan the flames of the bubble, but we can assure you we're not going to be long them when they absolutely implode.
On the Tape is presented by CME Group, where risk meets opportunity. iConnections, reimagining how the investment industry connects, and SoFi. Get your money right all in one app.
Welcome to the Monday edition of the On the Tape podcast. I am Dan Nathan. I am joined by Guy, Adami, and Liz Young. That would be EY from SoFi. Welcome, people.
Yo, ma.
There we go. All right, we got a lot to cover here this week. It is jobs week. We know that we get all geeked up about that. Guy is really pining away for the end of the week because we are going to get a lot of Fed speak. Your main man, Kashkari, on Wednesday. I think Jay Powell on Thursday, along with Mester here. And there's some other data going on other than jobs. We also have a couple big earnings announcements. I got to tell you, the Avago guy, you just call it Broadcom, that is reporting later on the week. And I don't know if you saw what happened to the Broadcom in Friday afternoon trade, but the thing absolutely blew out. It was up, more than 8%. I don't think it saw a downtick all day long. This stock is absolutely raging in a very different story, let's say, than in NVIDIA. But I think the most important point, we can debate it a little bit, is that the AI trade is broadening out within the semi space into some other areas in tech. Some might see that as bullish. We might see it as maybe they got here for the death rattle. We'll cover a bit of that. Also, Liz, you are in the strategist class here. It seems like many of your peers are tripping over each other to raise their S&P 500 targets. I guess a lot of those nifty little 5,000 round numbers coming into the year were not nifty enough. And then we'll talk about what voters are feeling. This is Super Tuesday tomorrow, and we know that a lot of the kind of registered voters, at least as they're being registered in the polls, are not particularly optimistic about the economy. That might be changing, but the current administration is not getting a whole heck of a lot of credit for any of that. And lastly, just a little housekeeping. Tomorrow, we have a special drop of OK Computer Funders and Founders series. We have the CEO and founder of Perplexity, and that's a company that we're going to be talking about, we think, a lot in the chat bot space, but they're not a chat bot. They are doing, they call themselves a search engine, and with Ann Bordetsky from NEA Capital, who led their Series A round. That's a great conversation. Tune in tomorrow morning. All right, guys, enough of me talking. Liz, let's talk a little bit about Savita Subramanian, friend of the pod over there at Bank of America. She's raising her target to 5,400. Talk to us about the psychology about keeping this process of ratcheting up your target as the market keeps moving away from your target, I guess the opposite way a little bit. What does that psychology say to you? You don't have targets. You're lucky enough not to have to do that. What does it say when you're just kind of chasing the market a little bit? And again, lots of folks are doing this. It's not an indictment of Savita or the strategist grouping either.
Yeah, well, I mean, you don't want to be left in the dust. And I wrote about this last week in the piece that was called "The Highs Keep Coming," and started it off by saying where we are right now, we're only at the end of February, and most of the S&P targets have already been surpassed. It was more than half of them that had been surpassed by all the strategists out there. The highest one at that point was 5,400, and that was only about 6 or 7% above where we were at the time. The median target was 5,060. And we've already surpassed the median. So I think when things like that happen, you should expect people to move their price targets up. Obviously, there's a lot of year left. And if they were bullish coming into the year, they have to be more bullish going forward. And if we're already there and there's a ton of momentum behind it, I don't think that it's a huge surprise that we're seeing people move their targets up. What does it mean about the psychology? I think it's that there's a little bit of FOMO going on, and that things have been stronger than what people expected already 2 months into the year. So now it's this catch up. I don't want to be last one to the party.
It's interesting. Savita also said that bull markets end with euphoria, and she doesn't think we're there yet in terms of euphoria. And maybe that's true. I don't know. I mean, it seems in some of these sectors that we talk about seemingly every day in these individual names, it's been nothing but euphoria for a period of time. But I think I understand what she's saying. And look, 5% higher from current levels ish, I guess, is what she's talking about. And it's maybe 6% in terms of her target, which is fine. But I think to your earlier point and to Liz's point, I think you're going to see more and more people start to play the chase game in terms of, where their expectations were for the S&P this year and where we're currently trading. And I think you're going to start to see that. Now, we'll see how it manifests itself. But clearly, I think there's a risk in being behind the curve here, and people want to try to get ahead of that because I think for the better part of 2023, a lot of people found themselves behind the curve, Dan.
Yeah, and this is obviously she's keying off a quote from John Templeton. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die of euphoria, right? So she's saying we're not at that euphoric level yet. And I guess, a really important point about this is like, okay, how are they justifying higher price targets other than just price, whether it's multiple expansion and the like? And I think that, as we're getting to the tag ends of Q4 earnings right now, there was a lot of optimism when it relates to kind of earnings, maybe possibly inflecting after, that earnings recession that we had, in 2023. And there was a lot of skepticism about 10%, 11% S&P 500 earnings growth, right? So if you feel like what you saw in Q4, what the cost cutting did, what margins were able to do, maybe revenue growth starting to re-accelerate, companies more focused on cost, riding the wave of some of these secular trends, right? And we'll talk a little bit about AI. I think it's really clear. We had Stuart Sopp on the pod guy on Friday, and we were talking about Klarna. This is a buy now, pay later company that's coming to market. And there was a story out. I think the company was actually, talking about their use of their AI assistant is doing the work of 700, customer service employees. Like if that's a theme that we start hearing more and more, you're going to see lots of that macro sentiment. It's going to kind of be infused a little bit with some of this sort of micro sort of stuff as it relates to different companies and specific industries and how that can drive earnings growth. And I guess, the point that I would just make there is like, if these adjustments higher are based on fundamental stuff, Liz, other than just multiple expansion, then we are not at that, like we have not passed the pessimism stage, because there's lots of folks out there who still believe that S&P 500 earnings, largely buoyed by the Mag 5 or 6 or whatever the hell they are now, you know what I mean, is really isolated to a small group of names. If it starts to move throughout their different industries, then that would be, I think, a strong tailwind for S&P earnings.
So I'm going to paint with a broad brush here because I don't think every strategist is moving their targets based on the same thing. But the debate that I think is going on, whether explicitly or implicitly, is are we actually experiencing late cycle euphoria, which is what bull markets die of, or are we experiencing more early to mid cycle broadening out and strength, true strength? Some of the price targets that move up will probably be predicated upon that idea that this is more early to mid cycle. We're at a different place in the cycle than we thought we were. We're going to be able to pull this off. Inflation becomes less of an issue. So if we're looking at the macro, that this macro setup then is actually better than people thought. Maybe the growth will be stronger. Maybe the labor market doesn't crack. All of those sorts of theses, I think, are what is going to be explaining some of these price targets moving up, which then you can drive productivity from that, margins stay intact, and so on and so forth, right? But I think the debate is still a good one to be having. I am not sold that we are early to mid cycle. I still think that there are a lot of signs of late cycle and that this market behavior, although yes, broadening out and strengthening, and I absolutely recognize that. And I do think that you should ride it as long as you can. But I'm skeptical of the fact that we would be at a point in the cycle where this just continues for another few years. I still think that I think there is more late cycle euphoria going on than early to mid cycle expansion.
I agree with that, and I'll add to that this. You mentioned cost cutting and the want to keep margins stable, if not improve margins. Well, that's just code for we're going to start laying people off. And that company that you mentioned earlier that Stu talked about, I mean, you think about AI replacing the amount of jobs, just sort of widen that out to a broad swath of industries. And once again, you understand how technology historically is the most deflationary force in the history of mankind. And to a certain extent, in the short term, I want to iterate, in the short term, it's very job unfriendly, right? I mean, over time, people will start to get into other fields, obviously on the back of this, but the knee-jerk reaction is unemployment's going to go up. And I'll say this, I do still think that if California was a country, which obviously it's not, but if it was a country, I think it would be the fifth or sixth largest economy on the planet. Their unemployment rate at the end of December was 5.1%. I just want to say again, that's 5.1%. You're talking about obviously the United States on the whole, still below 4%. Historically, California leads the broader United States by anywhere from 6 to 9 months. And I just think if you look at some of these other states, that's the trajectory of the unemployment numbers. Now, you're not seeing it in terms of the numbers that get publicized every month, and I understand that. But below the surface, and Elizabeth talks about this all the time, there's some damage being done to the job market. And again, when the economy is driven by people feeling good about things, we're going to have that conversation about people's thoughts on the economy. There has to be some concern that unemployment is going to start to rear its ugly head.
Well, I think too. It's almost like, do I have the flu or do I have COVID? The symptoms are very much the same. They present the same. The circumstances feel the same in the beginning, and there are a lot of similar circumstances that could present themselves in the market in early to mid cycle expansion and late cycle euphoria. And I think that's what's going on right now. I think markets would behave very much like they have been in the last few weeks in both circumstances. You don't actually find out whether or not it was the flu or COVID until maybe you figure out that you lost taste and smell. That's afterwards, right? So labor market is the aftermath. That's the latest thing that crashes, the latest thing that shows a symptom, and that's how you know. The one thing I would say is, if we were early to mid cycle, the unemployment rate would be on its way down. It would probably still be high and it would be coming down. We'd be adding jobs, but not at the fastest pace that we have. It would still be recovering because the labor market is the last thing to recover. It's the last thing to crack in a downturn.
Yeah, it's interesting. And again, we're talking about two different things, right? The stock market and how it's basically reflecting the news that's out there. So to Guy's point, if you look under the surface of that unemployment data, that's in the economy, right? And so at some point, the stock market has to start discounting it, but it's right now focused on basically the pessimism heading into the year about its ability to kind of hit consensus earnings estimates, right? Versus what's going on in the economy. And I think this push and pull between what AI does to jobs, right? Like, I think that's really important at a time where maybe some of the things under the surface as far as the employment didn't look that great anyway, even when we had 50-year low prints at 3.7. And this is one thing that caught my eye over the weekend. There was an article in Bloomberg, U.S. stocks amped up by big tech, better than expected earnings. There was one quote in here, and we've made this point, but I think it's really important as we kind of look back on Q4 earnings. It was talking about, the big beat by NVIDIA and what we saw out of the Magnificent Seven. It said the 7 largest stocks in the index, that's the S&P 500, from Apple to Meta, saw their profits rise 59% in the fourth quarter, excluding those firms. The remainder of the index posted a 1.6% profit drop. That's according to Bloomberg data. Okay, we've been obviously quoting FactSet data on Market Call saying similar sort of stuff. So if those names, right, if this boom doesn't continue, this is just really important here, right? If the boom doesn't continue, and we've already lost Google, we've lost Apple, they're down 10% from their highs. Tesla's down 50% from its all-time highs. It's down 20-some% just in the last few weeks. If we start losing, let's say, a Microsoft because whatever that pull forward that the stock saw about the fundamentals, right? And you start to see a deceleration in their beats, that's how the S&P turns really hard, Guy. Right? I mean, and I don't think that's something right now, make no mistake about it, the names in and around this situation as it relates to AI, they feel euphoric. And I wonder, with all the attention that we put on NVIDIA a couple weeks ago, if maybe it's Broadcom, maybe it's Avago that has rallied in sympathy. Very different valuation story, very different story as it relates to the products. They're not making GPUs and the like. But if that guidance is the one that maybe is not good enough, that maybe causes the stocks, the SMH to take a pause, Guy.
So it's a fair comment. I'll say this, and just in terms of how wrong one can be, that one being myself. I mean, Apple is going to open around 178 or so. We're obviously doing this the morning of March. I think today is March the 4th, if I'm not mistaken, right? So Apple's due to open around 177, 178. The all-time high was a little bit north of 199. If you had told me on, the beginning of March, Apple would be trading below 180, Google would have put in a bit of a double top. You mentioned Tesla. and then said, where's the S&P 500? I said, under those circumstances, knowing nothing else, the S&P is probably trading 4,600. And that's pretty reasonable, I think, in terms of the importance of Apple to the broader market. And obviously, that's not the case. You have an S&P 500, it's effectively making new highs every single day. So the ability for the market to rally in the face of what's been a very poor performance by Apple and to a certain extent Google as well, and maybe some of these other names on the periphery, is impressive in a word. I mean, Apple has now become, I think, a bit of a source of funds trade. So, that money coming out of Apple seemingly is going into names that people think they just get more bang for their buck. And that's a fascinating development, something we've seen before, but not all that often. And again, to Liz's earlier point, is it the flu or is it COVID? Is this, the signs of something worse, or is this sort of this benign thing that people are going to look past? And quite frankly, I think I know the answer, but clearly through the lens of the S&P, I don't.
Yeah, well, it's interesting, Liz. There was an article in the Journal over the weekend. Once a hot stock market trend has a name, its best days are likely past. And I thought some of the data was really interesting. So you remember FAANG, right? Well, we renamed it on Fast Money MAGA, right? It was the Microsoft, the Apple, the Google, the Amazon. And some of the data here was pretty good here. On average, once the trend has been named and looking ahead 12 months, an investor can still earn about 13 percentage points in excess returns. Yet 12 months following the naming is about the best you can do as returns peak at this point on average and decrease a bit subsequently from a 12-month mark to the 24-month mark. After a trend has been named, the average named trend lags behind the S&P 500 by 2 percentage points. Okay, so we're starting to see some of those names lag. Now, again, FAANG was years ago, but I think that the Magnificent Seven is what we're focused on right now, and I think we can all agree it's kind of the Fab Four, to Guy's point about Apple and some of the others.
Yeah, well, it's all along the same vein. We've talked about this a couple times in the last few weeks, the names that get added to the Dow. And I read on one of our shows basically how that gets chosen. One of the criteria was basically something along the lines of interest by investors. So names that have a lot of interest from investors get added to the Dow. Obviously, that's partly a momentum trade. That's, it's sentiment, it's what's interesting, it's what's popular. And a trend gets named when it's been popular and when it's been a driver. And I mean, meme stocks, that was something too. That continued on for a little while. We talked about it constantly, and then it stopped and it sort of reared its ugly head in other stocks too. But I think that's a lot of what's going on here. And yeah, the Mag 7 is over. There's another thing, and I don't remember who said this. Somebody recently had said, this goes on until maybe the Mag 7 or those big tech stocks get taken out to the shed and shot one by one. And is that what we're witnessing? I don't know. Maybe it's a rotation within. Maybe it's that we're finding new strength in other places. But are we starting to witness one by one, they go down? And it doesn't necessarily mean that they have to be the driver all the way down. But if we lose those strong ones and the rest of the index does not pick up the slack, which I think is what the bull case is that everybody else picks up the slack. If that doesn't occur, if that doesn't happen with sustained strength, like we haven't seen it happen for almost this whole cycle, then we're in trouble. But that's yet to be seen. And I'm not totally sold that I'm right or wrong about that. It could be that other stuff does pick up the slack.
Yeah, but here, Guy, and this is maybe something that's debatable among us. Like, I don't know how these other sectors pick up the slack, okay, without China, okay? And what's going on in China right now just seems to be like an unmitigated disaster. We talked a little bit on the pod last week about the Biden administration kind of firming up their stance towards Chinese EVs, dumping, here in the U.S. I mean, that is something that we've been talking about the prior administration, starting with the trade war in 2017 and all the tariffs. And, I think about this. There was an article in the Journal, the world is in for another China shock. And it's talking about a deflationary shock. It's talking about a dumping of all sorts of things, right? Their internal, consumption is not basically absorbing, their production, right? And as the rest of the world is moving towards reshoring, right? And for a whole host of different reasons, it just seems to me that we might go from, okay, this inflation, which right now, the market does not seem to care about pesky and persistent, right? Like we've stopped basically going down, right? And the way that, inflation year over year has been declining, has been decelerating dramatically. But right now, what if we do get in a situation where China floods the world with their cheap goods, right? There's just less demand for this sort of inputs, whether it be, commodities and the like, industrial commodities and stuff like that. Like, might we be in the phase of kind of a deflationary spiral like they're in? And that has been really bad, not only for their economy, for employment, but obviously for risk assets over there in China, guy.
I hear you on the inflation and deflation front, but I think the problem with the United States, and Elizabeth can talk about this far more intelligently than I, we don't really have a goods inflation problem necessarily. It's more of a service inflation thing, which China can do whatever the hell they want. They're not going to be able to sort of not fix that, but not going to make a dent in that. I think the most important point in all this thing is, for whatever reason, the market seems to be looking past all the problems that China is having. And that is, I think, in a word, a huge mistake, because you're still talking about the second largest economy in the world, and obviously the problems they're having are significant in a word. And I'm surprised that for whatever reason our market is just completely looking past that and thinking, you know what, that's isolated to China, it's not going to have an impact on us here. So I don't know if I necessarily answered your question. I think I understand what you said, but I don't necessarily think that the shitty goods that they're going to send over here are going to fix or assuage your concern on the inflation front.
Right. But if you're worried about services inflation, then wages are a huge part of that. And you also think that unemployment is going to go up, right? So to me, what it speaks of is a global economic malaise, you know what I mean?
Yes.
That is being exported from China. So the quickest way, I think, here in the US is like to have that unemployment go up is obviously recession fears to start working their way into the C-level suite and starting to see more job cuts, which will put pressure on service and inflation. And then you might get into a deflationary spiral, in my opinion, that starts with goods, that starts with, just this whole, kind of malaise being exported from China. And listen, you can worry about China from a geopolitical standpoint, from an economic standpoint, from a whole host of other things, right? But to me, one thing that people are not focused on is the potential for what a deflationary spiral moving in and around the world might be to the global economy, Liz.
I think it's an interesting premise, and honestly one that I haven't thought much about, because we're so focused on inflation coming down, and that's a good thing. And I think that the headline number initially, if what you're saying and what you're suggesting actually happens, the headline number actually will still be interpreted as positive, because if goods deflation does work its way into the system, it'll offset some of the issues that we're having with services inflation. The super core number will still look pretty bad, but it probably initially will be a positive and be interpreted that way. But the idea that you can't really stop it once it's rolling is one that I think we should think about. And the other thing, add on to that, take it one level further. If China is going through a bad deflationary spiral of their own, it gets exported, meaning we import it here. We turn into a deflationary spiral in some ways. The way to get out of that is global cyclicality, global growth, some way that the globe has to regrow. If China is in a deflationary spiral, there's demand that they can't fulfill, right? Their economy is suffering that they cannot fulfill not only consumer demand, which we've relied on an Asian consumer for a lot of different companies, a lot of different consumer-based companies here, but there's oil demand, there's a lot of other commodity demand that would be weaker, that could ripple through a lot of different markets.
Guy, isn't this the best case, though, scenario for quick cuts in interest rates? You know what I mean? Like, if you think about it, right? Like, if you're now all of a sudden focused on what deflationary measures might look like, like when we think about Fed funds futures and what they're pricing here now, coming into the year was 5 or 6 cuts, and now it's 3-ish or something like that. And again, a lot of the Fed speak, and we're gonna get a lot of it this week, seems to be kind of hawkish. I don't think they love the fact that risk asset prices are now inflating again. And I thought this was interesting, Liz. You might have put this in our show notes, but this was from Ed Yardeni talking about, and again, seems really bullish, Ed. I think Ed is often really bullish, but he's talking about the wealth effect, guy, that's being created by the stock market. Now, that's a bit of a misnomer, but it just seems like everywhere you look, there seems to be, and here's another term that's going to get y'all geeked up, green shoots about, there it is.
The wealth
for the listeners over there. There it is.
I want to do like freeze that screen when Guy made that face.
The wealth effect is for it's typically, again, for a very finite group of people. I mean, the wealth effect, the people that are getting screwed in all this inflation, the people that actually have to buy groceries and pay for things and figure out if they're going to pay their heating bill or their food bill. I mean, those, they don't even know what the effing wealth effect is. I mean, it's such a foreign term, and it's so insulting to them that the fact that people even put that out there is a problematic. And you talk about people being tone deaf. I mean, that's about as tone deaf as you get. Yeah, so it's great for people that are hanging out at their beach houses and such and having their cocktail parties, and they can laugh about the price of gasoline and the fact that they're paying more for a box of Cheerios. But the reality is, for a lot of people, they have to make decisions based on this. And, they couldn't tell you where the S&P 500 is because, quite frankly, it has no impact whatsoever on their lives. And therein lies one of the problems as well. The rich get richer and the wealth gap continues to widen out. And that's been happening now for the last few years without question.
Yeah. Hey, really quickly. So, you just mentioned, here we are. It's Monday morning. It's right on the opening as we're speaking right now. And to your point, Guy, Apple was hit with an EU fine of close to $2 billion on some of their practice as it relates to streaming music. And it's interesting that the stock is down, gap down 2% on that. When you think about $2 billion, that's really a rounding error for a company with all the cash that they have. But it really speaks to maybe the kind of regulatory headwinds that some of these huge platform companies have. Now, on the flip side of that, Taiwan Semi gaps up 5%. Like, think about that, okay? Like, that is not a small move, okay, for not a small stock here, okay? This is a company that has a market cap that's going to get close to $1 trillion. This is like, probably the next one on that kind of $1 trillion watch, especially as we think about this. Supermicro, a stock that's up 200% this year, gaps up 15%. It's being added to the S&P 500. We spent a lot of time talking about how this stock was getting kind of big for the Russell 2000 when you think that it crossed that $50 billion market cap. But Google is down 2.5%. So my point is like the names that have been anointed, right? Like, they are just ripping. Nvidia's up 2.5%. That stock is up, more than, I don't know, it's close to 70% of the year, $850-ish. It feels like that's making a straight shot for 1,000. Talk about admitting being wrong. I couldn't have been more wrong about that one, Guy, even as we saw that quarter and the guide that they put up relative to the quarters and the guides that they were putting up last year. But the heart wants what it wants, Liz. And it seems like investors are hell-bent on just working the ones that are, you know what I mean? Like the ones that are just, the story seems intact. But like, here's one thing I will tell you. And Guy and I have been around a couple more cycles than you, Liz. If I didn't have a mic in front of my face or a camera in front of my face every day of the week, I'd be trading a bunch of these things, okay? That's how I was trained. That's how Guy was trained in the commodity market. And you know what I mean? Like, momentum's momentum. And it's a great opportunity to make money, especially in a bubble. And that term bubble doesn't have to be a negative thing. But as a pundit, I can assure you, I'm just not going to be on the sides of bubbles because I've seen what happens when they burst, largely for the people who get sucked in and they don't know how to get out, right? They don't know how to take a profit, and they certainly don't know how to take a first loss, okay? So that's one thing I think, Guy, you and I are in agreement at Risk Reversal Media. We're not going to do it. We're not going to fan the flames of the bubble, but we can assure you we're not going to be long them when they absolutely implode. So Liz, talk to me a little bit about this, because every day is a different example. Apple and Google down, Supermicro, Nvidia, Taiwan Semi up, right? And that just has the ingredients of something that, when it comes unwound, is going to be very difficult for, I think, a lot of investors who are not professionals.
Well, to your statement of the heart wants what it wants, there's something romantic about the idea, and I think that a lot of investors want this to be the case. The idea that if a small cap graduates into mid cap and then graduates into large cap, that is the story. That is how you want the story to go. I used to cover a company, an asset manager, who called small caps the next generation of blue chips. That is the goal. So there is something romantic and American dreamish about watching an entrepreneurial company grow into a $50 billion enterprise. And I think that that's great. And I think that people should experience that and be able to understand that that is the point of long-term investing. However, the question then is, if you don't want to be exposed to the bubble, and if we look at what we would consider the bubble right now, I think it has been pretty obvious. You can just literally pull up the S&P 500, sort by 1-year returns, and see where the bubbly stocks are. So if you want to take part in momentum, though, how do you take part in it without being exposed to the bubble? Which is when you have to do some more work. You have to drill down into which ones have lagged, which ones along this theme. If this bubble is predicated on a couple themes, which it is, which ones in that theme are still healthy companies but have lagged? And that's what you start to dip your toe into to try to take part in the rising tide lifting all ships. And I think where we are right now in the cycle, whether it's late cycle euphoria or early cycle, whatever we want to call it, is that the broadening out is where you can benefit now and not be exposing yourself too much to the stuff that's already become bubbly. So looking at where is the broadening happening, but it hasn't quite picked up steam yet. You can look probably in a few places in industrials. I would pick certain names in industrials. You can probably still find some healthcare names that have been left behind in the biotech space. You can probably still find some AI themed names that aren't up 100% over the last year. And that's where you start to pick and choose, but making sure that you're not overly exposing yourself to stuff that just has been a laggard. Make sure that you still have exposure to the other stuff that seems boring and also hasn't taken part, because if and when the bubble bursts, that's the stuff that you want to be holding.
Hey, Guy, this a lot of comparisons to what's going on with AI related names, semi names. Carter Braxton Worth of Worth Charting has highlighted this on many occasions. He actually had a note out over the weekend, and he was talking about it last week on Market Call with us every Monday through Thursday at 1 p.m. on the Risk Versal Media YouTube page. So check that out, people. He's going to be on with us today. But he was mentioning that the semiconductor index relative to the S&P, relative to other parts of the S&P tech sector, has just gotten back on a relative basis to its 2000 highs. Think about that, 24 years, right? And that's kind of the point that we're making. If you buy into bubbles, you might have the ability to make some short-term profits, but if you don't know how to take that profit or take a loss, it can become very difficult, especially if you get married to that trade. And, like when I think about this guy, I just say to myself, okay, like I get it, but it's feeling a lot more like early 2000, about March 4th, 2000, than it is in late 99 when things were still raging. Because what happened in 2000, nobody wanted, on that first pullback in internet stocks, nobody wanted to believe that the bubble was popping, right? And so that's what, I'm just curious, talk to us a little bit about that psychology. And I know it's just not that neat that we can kind of look back 24 years and say, put your finger on exactly the similar sentiment, but it does feel eerily similar, Guy.
Think about what's going on with Japan. I mean, think about when it made its all-time high in form of the Nikkei. Think about what's happened in the decades since, and think about what's happened over the last, obviously, 6, 9, 12 months, where we're getting right back to levels that we saw, I want to say, was some 30 or so years ago, right? So it takes, to your point, it's great on the way up if you're disciplined enough to get out. But if you're not, you see how long it takes in the aftermath to sort of make back all the ground that you lost. And sometimes it takes years, and sometimes it takes decades, and other times it never happens at all. So you have to be aware. I think, listen, clearly I want to emphasize, in terms of a lot of these names, it would have been impossible for me to be more wrong in terms of the ascension of these stocks. But I also know throughout history and throughout my history in the business, it's just a matter of time before something happens that knocks these things off the pedestal. And my fear continues to be, for a lot of these names, more people wind up losing money than making money, as counterintuitive as that might sound.
Well, and listen, you hear that term in markets all the time, Liz, escalator up, elevator down. But I'll tell you, one of the things that scares me most is elevator up, because that elevator down is like sometimes they cut the cord on the way up. You know what I'm saying? Liz, really quickly, we have lots of strategists, and this is before we get out of here, last thing here, who come on and we ask about geopolitics, we'll ask about domestic politics, right? And a lot of folks of late have said, really, when they look back at history, it doesn't really matter until you get into like kind of late summer. I think you've said that, early fall sort of thing, right? Article in the Journal over the weekend, voters are more upbeat on economy, but Biden gets little benefit. That's from a Wall Street Journal poll. 31% of voters in the survey said the economy has gotten better over the past 2 years. A rise of 10 percentage points from a Journal poll in December. That's a pretty big rise. And 43% said their personal finances are headed in the right direction, a 9% increase from the prior survey. More than 2/3 of voters say inflation is headed in the wrong direction. So that's the thing I think that people are kind of pegging on the current administration. thoughts there, because my view is like none of this data gets particularly better for the current administration between now and November. You'd have to have an all-out, like, think about everything that we just talked about: the economy, about markets, about geopolitics, about international, growth and the like. They would all have to get better, you know what I mean, for this to be meaningful better. I think if we're taking this poll in mid-October of this year, weeks before the election. So might this play more of a role, you know what I mean, like this sort of stuff in the election and the outcomes this year? And again, I'm not asking for a prediction. I'm just curious how you're thinking about this right now.
Well, I agree. I don't think the data is going to get meaningfully better. The best case scenario for the current administration is that there's no recession, there's no huge market drop, and that inflation doesn't go back up, because they need those polls to stay about the same. If that's the case, then it ends up being an election that's based on some other stuff. And that's where the market gets a little hairy in places like healthcare, defense stocks, things that are going to be proposed changes to our current way of doing it. The thing about this election that I think is going to be pretty wild, actually, is that we could end up with a repeat of an election we've already watched. And markets like it when things don't change that much. So if we're in another sort of gridlock scenario, it may end up being a year that's really frustrating in the sense of there's choppiness in certain areas, but it's not really bad broadly because it's gridlock, because it's two known quantities, and one of the two of them ends up in the seat, and maybe we're still about 50-50 in Congress, right? That's actually kind of a good scenario for markets. Maybe not for the economy, but for markets it would be. So that's why, again, we will talk about the election until the election is over, but I wouldn't change my strategic allocation based on an election that's coming in the next 8 months.
Think about what you just talked about in terms of this poll, which, I love a good poll. But in terms of what's going on, people don't feel good about the economy. Now, a few minutes ago, we had a conversation about what Ed Yardeni was saying about the wealth effect and how people should be benefiting from that. Well, I mean, what this poll suggests is exactly what I said before, that for a lot of people, whatever happened in the stock market means nothing, because if it meant something, they'd feel a whole lot better about the economy than they currently do. So, again, depending on the lens you want to look through, you can make numbers and all these things look wherever you want. The reality is the stock market's rallying. It's helping a very few amount of people in terms of percentage of the population, and the rest of the people are hurting. And in terms of this election, I think we would all agree, regardless of outcome, half this country is going to be pissed off about something. I mean, that's just factually true.
Yep, no doubt. All right, last thing. So Jerome Powell, we said, speaks on Thursday. Friday morning, we have that jobs report. We have to assume that anything that he says on Thursday is going to incorporate some of the data that we get on Friday. Liz, what does the market want to see for the jobs report here? Because, again, I think Guy kind of laid it out earlier, and you did too. A weak jobs report obviously would be downward pressure on yields, right? And, it's one of those things where stocks have liked over the last few months, right? But the Fed has been pretty hawkish, despite the fact that, you know what I mean? Like all signs are turning toward maybe economy that's not gaining steam. If anything, it's kind of has the potential to weaken, especially if we see unemployment go up. So it seems like we're in a bit of a conundrum. And I guess we're speaking of it through the lens of the markets here. We're in a conundrum because if the economy were to weaken and obviously the Fed turns tail and gets a bit more dovish, should not be great for risk assets, especially where they are with valuations and the multiple expansion we've seen and the concentration of where the earnings growth, which we just highlighted, where it's come from.
I think it would take a negative jobs report, meaning a negative print, in order to make that connection as explicitly as it would result in the market going down. Meaning we'd have to have negative jobs added, and then the Fed to come out and say something that was much more dovish. Then it looks reactionary to that. I think what the market wants is probably a cool jobs report, one that is still adding jobs, but not at a super fast clip, so that it doesn't look like the labor market is retightening. But that's sort of where we've been for the last few months, just chugging along at a cooler level, but a still growing level, and things seem okay. I don't know what the report is going to look like. I think we've seen so many times all the warning signs or what ADP comes out as versus what the non-farm payrolls come out as, and they're completely different, totally other sides of the coin. So I think the market just wants something sort of benign, I don't think they want a negative print. And I think the first negative print, if we get one, is what sends things into a little bit of a tailspin.
The key to this entire puzzle, I think, continues to be the labor market. And, I've thought incorrectly that you're going to start to see a stair step higher on the unemployment rate. That clearly has not been the case. But if you look at some of the data, the individual states that are reporting, I mentioned California earlier, all signs point to unemployment rising at some point in a way that I don't think the market fully anticipates. And I know that's the Fed's want for the unemployment rate to go higher, but just in the same way they thought they could control the inflation that they begged for years is probably the same way they think they control the unemployment rate, which they clearly won't be able to. So when this thing starts to move, I think it's going to surprise people how quickly we go from sort of 3.7 to 4.5, and then potentially north of 5% in a way that I don't think the market's prepared for. And before we get out of here, you mentioned all the important things that are taking place this week, and you were correct to do so. What you left out, probably by choice, is the fact that Friday at 3 p.m. is the NHL trade deadline.
Oh,
so
yeah.
a lot of decisions are going to be made this week in terms of how teams gear up for the NHL postseason, which is basically going to happen like this.
And Liz, and you know why Guy is all geeked up. This is the 30-year anniversary of the Stanley Cup winner. That would be the New York Rangers. And these guys,
I didn't know that.
They are just rolling right now. So, Guy, I know you don't like to touch the money. It's only
No, you
March.
don't touch anything.
I know, but who cares? Okay, the team's playing great. You should be very happy. Maybe they make a couple good moves late this week. All right, guys, we covered a lot of ground here. I think this is a really big week in the markets here. And so keep an eye on some of those earnings. Keep an eye on that Fed speak. Obviously, that jobs report at the end. All the data, I think we're all in agreement coming out of China, is one of those things that for whatever reason, markets don't seem to care. They seem to be focused on a handful of names here. The broadening out of this market, to me, I think it's on kind of shaky ground because some of the stuff that we're seeing in some of these sectors, small caps and biotechs and this and that, whatever, it just doesn't, they're not going to, there's not enough going on. Guy, I know you're focused on the energy market. I know you're focused on WTI at $80. It was just at $70 not too long ago. What is that saying if it's not built on proper demand, if you like? And I'll just mention one other thing because we haven't mentioned the name and I just want to do it. Tesla's down nearly 5% shortly after the opening here. This is how NVIDIA, like again, that article that we highlighted in the Wall Street Journal, once you start naming these sorts of trends, I mean, think about the narrative around EVs 2 or 3 years ago. It was going to destroy, like Detroit automakers, ICE cars, and this and that, whatever. And think about how different that is. Think about how far GM and Ford have come off of their lows in the not so distant future, right? Or, you know what I mean? Or not so distant past. So I'm just saying, like, to see what's gone on with a stock like Tesla is how you can see what can happen around these GPU stories as the story changes once all these large language models are trained, once the triple and double ordering is done, once the China bans are fully in effect, once the commercialization of some of these products doesn't hit the lofty, euphoric, you know what I mean? What people are expecting right now, what's built into the stocks. That's how these things come undone, right? And sometimes they come undone in a single name, like the way it's happened in Tesla. Sometimes it happens as a group. So that's why we keep talking about some of these names. All right, Liz Young, EY from SoFi, thank you so much. You'll be back with Guy and me on Market Call on Wednesday. Guy, you and I are just going to be back. We're just going to keep doing it all week long. I'll see you on the Market Call later. I'll see you on Fast Money. And by the way, go leave a review for the OK Computer podcast, the Kara Swisher review, review the Perplexity CEO, whatever you want. Leave a review, send it to contact@riskversal.com. Get a free copy of Burn Book. That's Kara Swisher's book that is doing great. I read it. I loved it. Guy and I talked to her. So go do that. Get a free book. Thanks, everyone. We'll see you.